here, they have two different titles, but they all lead to the same place. And we're going to be talking to you today about some things that are really, really important in terms of the overall planning process. And I know, first of all, I want to congratulate every single one of you for coming out here, because this is really about education. You guys are trying to learn how to increase whatever wealth that you have, learn new strategies. And by the way, if we could turn the phones to vibrate, I would appreciate it. Ronnie, thank you so much. So I think that's really, really important. And I think the main focus of this, my talk with you today is really to talk to you about some things that people are not talking to you about. And when you look at the overall scope of the environment of where we are in the stock market, there are some key issues that people are not addressing. So I want to start with you. We talk about artificial intelligence. Just a quick disclaimer. Everybody's got disclaimers here. That's what our attorneys tell us to put up there. And this is me. Now, I have several different designations. The one I'm most proud about is a certified financial educator. Because if we can give you the right education, you're smart people. You're going to make some smart decisions. A little bit about in terms of why I do what I do. Just a quick story. My father, who is 74 years old, unfortunately today still has to work. When we're saving money and we're investing our money, it's to get us to a place of retirement, financial independence, correct? It's the ability of having the opportunity to work, the option to work, or not working. And my father, who did a lot of really, really smart things, he bought GE stock in the 70s, and he bought real estate in downtown Brooklyn before it became downtown Brooklyn. But here's the thing, my father never had a plan. And the market has cycles, does it not? Right? It goes up and it goes down. And as a result of not having a plan, even the best investments that he made turned out to be not as great as he thought they were going to be. So that's really what this is about today. Okay? So, a little bit more about my background here. Fine. So, if we could define a retirement wish list, right? Let's think about it. What would we have? And by the way, I'm speaking a little bit quickly. We have a lot of material to cover. I want you to take some notes, because you're really going to have some things today that you can take with you no matter what, and it's going to really have a positive impact on your overall financial position. So, number one, we would like to eliminate costly taxes. Are you aware that the biggest expense in retirement is going to be taxes? Huge, huge issue. I have clients of mine that come in and they're taking money out of their retirement accounts, and they realize they take a lot more money out because they have to factor in taxes. Number two, we want to minimize stock market risk. How many people, when you hit that magic retirement button, you want to be worried about like what went on today, or the potential of the market going down, or Iran, or North Korea? Anybody want to be worried about that when you're sitting on a cruise? No. So we want to find out how to minimize the risk. Also, we want to create streams of income, potentially tax-free forever. Right? We're going to talk about that. That's huge. Because here's the deal. When we get to retirement, it's not about the assets we have. It's about the income that can be generated off of those assets. Does that make any sense whatsoever? Right? So it's so important. We're going to talk about that. Safety and protection. I don't know about you. People like safety and protection. We want some certainty. We live in a world where there is no certainty. Whether it's trying to get somebody on the Supreme Court, whether it's something with Russia, whether it's whatever, right? We would like some certainty in our own personal financial life. Wouldn't that make sense? Okay. And we want access to our money when we want it, correct? And control. So this would be an ideal retirement wish list. Okay? But there are some risks now as we face in retirement. Number one, longevity risk. Look, ladies and gentlemen, great news. Due to modern medicine and modern pharmacology, we're all living longer, right? And that's a great thing. But the reality is that there are people who will probably be living longer in retirement than they were actually working. That's a great thing. The challenge is we have to take all the money that we make, through whatever strategies you make that last as long as you do, and factor in other things. Interest rate risks. Anybody's been following the market today? Market had it's down. Why? Why? Because there's concerns about the interest rate, right? And it's on a plus and a minus. We just came off of a decade of basically zero rate of return on our money, correct? Now interest rates are impacting the market in a different level. Market risk, we talked about that. And then finally I talked about tax risk. So talk about, and by the way, any questions you guys have, we're going through high level, please come by our booth. We're going to get really more granular on that. Let's talk about IRAs or 401ks, right? Anybody here have an IRA, right? And potentially over the many years I've been doing this, that's a very large asset that people have, right? So let's talk about this, right? I don't know if everybody can see this. Let's talk about the things that we own in our life. We have a home, we have a car, our own personal life, jewelry, boat. All of these things, we have insurance on those things in case something happens? Yes? Right, it makes sense. But yet, does anybody have insurance on their IRA or their 401k plan? Does that logically make sense? That's one of our biggest assets. So people don't even know that that's even possible. So that's certainly something that I try to encourage people to talk about, because this is being in the financial planning world and doing this. It's sort of like Groundhog's Day. I saw it in 1987. I saw it in mid 90s. I saw it in 2000. I saw it in 2007. And of course, the stock market only goes up. Is that correct? Oh, I'm sorry. I'm going to make a change to the slide. Okay. So very, very important. It's a very important asset. Let's talk about this. Some concerns. We're going to get to some really good solutions today. But I want to talk about some concerns that nobody's talking about that could have a significant impact, even if you make the money that you plan on making. So people are working into retirement. Why? There's a lot of reasons why they're doing that, because they're trying to make money back that they used to make. We talked about living life longer. There's a new standard of living. It's not like people are retiring and spending less money, right? Things cost more money. How much does your iPhone cost? Okay, inflation, a big one. Does anybody remember what was the price of your first house that you bought? Right? Think about that. What it costs today. Social Security may not be adequate for retirement. Now, people may laugh at that, but guess what? The average person will pull out close to $1 million over their lifetime, right? But that may not be adequate. We're going to talk about that. Insufficient personal savings. Many reasons for that. We'll talk about that as well. Social Security. This chart basically depicts and says, look, the Social Security program, which we could have, I teach classes on this separately, we're not going to get into it there. They say that in 2035, that they plan on, because they have to make all these changes to keep up with all the baby boomers that are taking money out, that they're going to have a 21% decrease in income from Social Security. So I want to ask you a question, by show of hands, how many people, when you're in retirement and you're using Social Security as part of your streams of income, want a 21% decrease in income? Nobody, right? Very important to have this in the planning process. And nearly half of all married couples in this country use Social Security as a primary source of their income. Okay? Pensions, right? You remember pensions? It used to be, there was no retirement planning. You worked for a company for 40 years, right? They send you had a party, they give you a gold watch, and they send you off with something else. What do they send you off with? A pension, right? You put your money in the bank, you made 12% on a CD, and that was the end of the story. Not the case anymore. This graph shows how pensions have decreased. Only 3% of all companies today have pensions. And how what they've done is said, look, we're going to take the risk from us, and we're going to throw it back to you in the form of what? 401ks. You take the risk. Did anybody lose money in 2008? Right? Think about that. So very, very important to consider that as we look at their assets here. Baby boomers, right? People in this room. Do you realize that there are 10,000 baby boomers retiring every single day? And that's going to happen for the next 17 years. Let me ask you a question. Do you think people who are retiring are putting money into the system or taking it out? Taking it out, right? Could that have an impact? Okay? Healthcare. This, ladies and gentlemen, is a whopper. Okay? This is an article that came out, and it said the average couple in retirement is going to need to set aside close to $300,000 just for healthcare costs. Now, this is not assuming that there is a catastrophic long-term care health issue. Anybody here know of somebody that's caring for an elderly person, somebody that has Alzheimer's, right? Critical to have something set up in your plan. Because let's say you saved your $1 million. Okay, well, how long is that going to last? Have you factored in all these other issues, taxes and home health, long-term care? And one of the things that I try to share with my clients on, this is very important, but I'm not a big proponent of long-term health care insurance. I don't like things that They can change the game on you, they can change the rates. But I am a proponent of creating a part of your plan to make sure in case something happens, you don't ruin all of your your assets. So I want you to write this down. There's something called asset-based long-term care. Asset-based long-term care. That's not, you don't have premiums on it. It's basically taking a portion of your assets and providing lifetime medical needs in case that happens. But if it doesn't happen, and you're one of the few that it doesn't happen, there's 7 out of 10 people in this room that it will happen. But if you're the 3 out of 10, instead of having that money go to an insurance company, it will go to your beneficiaries. So very important. It's called asset-based long-term care. And if you don't take care of that, you can do all the planning you want, but you drain assets pretty quickly. Okay? An interesting article came out, and the AARP always has this. They always ask retirees, "What's your #1 fear in retirement?" Anybody guess? Outliving your money is more of a fear than dying. People would rather be dead because think about it, right? Who wants to be a burden on our children or our grandchildren? So important that you get that income. You have to prepare for D-Day. It's called the distribution day, and you have to make sure those checks come as long as you're still here. Does that make sense? Okay? So 2 important questions before we get to some of our solutions. Number 1 is ask yourself, how much risk can we afford to take? The second question is, once you answer that, is how much risk are you willing to take? Meaning, if you were to create a plan, what we try to do for our clients is you create a plan and you've solved for X. I want to retire here with this much money. I've done all the things I want to do. Do you want to take more risk? That's a question you have to answer to yourself. Okay? And we're doing this over many, many years. People know how much money they have. They look at their statement, I have this much money. The question is, they don't know what they can expect from that money. I have this annuity, I have this option, I have this 401k. But they don't know, how do I take that and turn it to streams of income? I have to replace my income. Very important to know that question. So getting to the solution. Now, the great news is there are solutions for all these things. But like anything else in life, you have to know who the people are that are giving you the potential solutions, right? So what's the motivation? What's the motivation of somebody giving you the advice? And this is, if I have to tell you the one thing that you can take away from today, this is going to be it. Okay? We've heard about fiduciary versus suitability. It's been all over the news. You've heard about that. So an advisor that's in a fiduciary capacity, right, has to do things in your best interest. I mean, that's about as simple as I can make it. When they look at the client, it's not what do I have, it's what's in the best interest of the client. Where most people that come to my office, right, they deal with a broker. A broker, whether it's Merrill Lynch or Wells Fargo, any of the big names, right, they only have what they call a suitability standard. And here's the thing, they get paid commissions from those products. So they're there to act on behalf of UBS, Merrill Lynch, Wells Fargo. So if whatever it is that you specifically need is not in their toolkit, you think they're going to just say goodbye? No, they're going to try to create a strategy that you will fit into, the square peg in the round hole. Does that make sense? Because this is the biggest concern that I have when I meet with people over and over. They can't understand why they have what they have. And go home and ask yourself, look at your portfolios. Why do you have the mix of stocks or mutual funds or whatever? They ask why. Why do I have the annuity? Why do I have this insurance policy? Why? And if you can answer that question, then you're in better shape than most. Okay? So what we want to do is we want to research potential investments as a fiduciary. My role is very simple. My role is to sit with people and say, I need to find out there in the universe of investment options, what is going to be the best that fits in for my clients. I like low risk, low volatility, but successful solutions. I want to make money, but I don't want to have all of my money at risk at that point, correct? So I want to have an opportunity to preserve what I have while I'm making money. Does that kind of make sense? Okay? So I can go outside the box. I don't work for a company, I work for my clients. Very simple. So it's not like, you're dealing with a Mass Mutual person or somebody with Raymond James. Whatever it is that's going to fit my client, that's what we have to do. And in addition to stocks, bonds, and mutual funds, right, I research different alternative investments that have safety, that can give people additional areas of way that they can create more success for themselves. And by the way, just so you know, people, number one question I get is, so I'm my own registered investment advisory firm, not we're fiduciary based. We don't hold your money. You've heard of companies like TD Ameritrade, right? Custodians hold them. We are the architects, and we sit there and plan and guide together with you to answer this question. Okay? Some of the tools that I offer to my clients are very simple. We're going to talk about, this is going to be a very, very unique piece that you guys are really going to love. It's artificial intelligence. It's called Solomon API. We're going to be talking about that. Asset lock. You've seen the banner. Who's watching your money? You can put this on any investment account, your 401k, any brokerage account. Who's watching your money? Okay? Self-directed IRA is a critical piece that people are not making, that are not utilizing, but the very wealthy people are using. Okay? And non-correlated assets, right? So even as bad as things were in 2008, there were people making money to non-correlated assets. Okay, does that make sense so far? Great. So I want to introduce. We're very, very fortunate to have. I research a lot of these institutional investment platforms. Matthew Mylan, he is the Chief Investment Officer of Solomon API, and I brought him here to share with us just an overview of what this investment style is on the investments that we have. So Matthew, please come on up and just share with everybody a little bit about Solomon API. Thank you.
Thank you, Richard. So how many of you here, do you guys know who Solomon is in the Old Testament?
Yes, sir.
All right, that's where we got it from. A little bit about Solomon API. Solomon is algorithm systems. How many understand that the markets today, right now, 90% of all the volume on the New York Stock Exchange is done through algorithms. Not done through people anymore. When you look at CNBC and they show the New York Stock Exchange, nothing's going on there. That's all for show. It's actually across the river in New Jersey. Sure. So where this starts from, or where the story starts from, is we have to go all the way back. When I started my career back in 1997, do you guys, anybody remember Peter Lynch? Right? He ran the Magellan Fund, right? Well, when I started my career, I was on the advisor council at Fidelity. When I was on the advisor council, every few months we'd be up in Boston, we'd be seeing all these guys. Well, when Peter ran that fund, it did almost 20% annual average return for almost 20 years. Pretty good numbers, right? So what Fidelity wanted to do is they wanted to know how the average investor did in that fund. Think about it. The largest mutual fund at the time, largest, they wanted to do a study on it. And the results that came back shocked them. They found out that more investors lost money in the fund than made money. Think about that. Their largest fund, more investors lost money in the fund than made money. You know how? Because one, they are letting emotions take control of how they invest. Right? Fear and greed. And what that led to was the psychology of investing, neural finance, behavioral finance. If you guys ever read anything on that, especially if you're going to be a successful investor, read up on it. Find out what makes you tick as an investor. Because I'm telling you, if you can take the emotions out of it, you'll be far better. So what they found is that people were calling up Fidelity, because back then they didn't have computers, or most people didn't. They were calling up Fidelity when the market started going down and they were losing money, and they said, get me out. And then when the market went back to its highs, they said, oh, it's safe, get me back in. And they didn't do it once or twice. They did it over and over and over again over that period of time. So they're effectively, you're shooting yourself in the foot. So keep that in mind. Because we're all hardwired to do the wrong thing. Every investor is. I don't care if you're Warren Buffett. Everybody's hardwired to do the wrong thing. So this leads to algorithm systems. Algorithms, we take out the emotions out of everything. And I think David Siegel said this best, that no human investment manager is going to be able to beat the computer in the future. I think we're already here, by the way. There's systems, you don't hear about them, but there's systems out there. Goldman Sachs has them. They've gone years without having a single day losing money. Years without trading losses. But to get a seat at the table, you better have a couple $100 million. So this is a really cool chart that I'm going to show you, or picture. This is the trading floor back in 2008 at UBS. This is a normal trading floor, kind of like a boiler pin. This is where they would be grinding away numbers. These are the analysts, these are the technicians doing their work. Fast forwarded, this is a picture in 2016. What happened to them? That's right, they're gone. Why are they gone? Computers took over. They don't need them anymore. One of my relatives called me up about 6 years ago. He said, Matthew, you got a job for me? I said, no. What's wrong? What he was talking about is he was the head of a currency trading in in Wall Street for a big Japanese firm. 6 years ago, they brought in a group from MIT. They created this algorithm system. It started trading better than their entire team. They let the team go. That's the future. So what Solomon is it's our group of algorithm systems that we use. And by the way, think about it. Algorithm systems can be very, very basic, by the way. In fact, there's systems out there. Do you guys know what moving averages are? Like a 50-day moving average, 200-day moving average? There are people out there managing billions and billions and billions of dollars with their so-called black box that all it is a crossover the 50-day and 200-day. And by the way, that only works maybe 60% of the time. Not that great odds, but it doesn't matter. They're managing lots and lots of money with it. But sophisticated algorithms can span the whole universe. It's not just that area. So one of the things that we wanted to do is, how do we bring artificial intelligence, or a form of it, from our institutional money that we manage down to the retail investor? Because this is not something that's out there right now, ladies and gentlemen. It's not. You can go around and go to A.J. Edwards, they wouldn't even know what that is. Same with Merrill Lynch. They wouldn't know. And these are the three pillars that we're using. So I'm going to talk a little bit about them. We don't have a lot of time here. But what we wanted to do is start off with, does anybody know who Vanguard is? Right? I could have used Fidelity. We could have, but we didn't. We wanted to use Vanguard. We didn't want to reinvent the wheel, so we used Vanguard ETFs. In fact, we took, for our strategic models, just Vanguard portfolios that have been around since 2000. You know, these are just buy and hold Vanguard portfolios, very low cost, right? They're stalwarts in the industry. And we said, okay, let's improve on them. Let's put Solomon on top of them and see how that changes. And remember, the Vanguard portfolios, they're using modern portfolio theory. Harry Markowitz won the Nobel Prize in economics back in the 50s, right? Well, modern portfolio theory is predominantly used to this day for investment management. The whole design of modern portfolio theory was for risk management. It was helping investors get from A to B, diversify, having non-correlating assets that do different things, to smooth out the ride, right? So that the emotions, you stay emotionally strong as an investor. But what we found back in 2008 is that modern portfolio theory has limitations. People got hurt in 2008. It didn't matter if you were diversified. If you were diversified, you still got crushed. It was that was the year that they threw out the baby with the bathwater, remember? Everything went down, just about. And things that actually should have gone up went down. So taking a existing portfolio from Vanguard, what we're able to do, all right, I'm going to go ahead and move that slide ahead. It's stuck. Technology's great, isn't it? All right. Actually, it's still not working. Maybe the battery's on here, did it?
It's an algorithm,
It's a bad one. We're going to take care of it when you get home. So, I mean, let me tell you a little bit about some of the algorithm systems. So, you can have an algorithm system right now, pretty basic systems that we started with back in 2007, 2008. But as computing speeds got better, as systems got better, we've been able to make them more and more sophisticated. So back then, they were kind of like a tic-tac-toe program, pretty basic. Now they're like a master chess program. And they run 23 hours a day because they follow E-mini futures. They do all these really, really, really cool stuff. And computing speed's gone up so much. It's amazing. I can't tell you, I mean, our chief technical officers, they talk about how fast computers are now than they were just 2 years ago. and they keep wanting to increase the budget on how much we spend on new computers. I don't know if they're lying to me or not, but that's one of the things that I have to deal with. So, yeah, if you want to go to the next one? I'll just tell you what to do. So, what you're going to see here is, go ahead and click it again. This is a portfolio from Vanguard, a typical 80-20, 80% equity, 20% fixed income. Since 2000, you would have made money in it, a buy and hold investor, right? You would have gone through 2 big major bear markets, a couple corrections along the way. Yeah, probably a couple heart attacks, right? I'll go ahead and click it again. But when you put Solomon on top of it, our algorithm systems, it improves your odds, because what that system is looking for is what is the next major trend change in the market. So, to give you an example, click it again. These are the time frames that it got out, got back in. Do it again. Okay. So, now, by the way, trend systems, even the most sophisticated algorithm systems, we have them looking at monthly charts. Well, when they look at monthly charts, they're not going to catch a 9/11 event, by the way. These things aren't perfect. But what we do is when you layer them, and the systems are able to weigh different technical measurements, and I could go through a whole host of them that actually follows 150 different technical indicators per day, every second of the day. And there's 24 subsystems that each one of them is doing that. So these things are really, really busy. What they're looking for is, when is the next major downtrend starting? Now, again, you have to have raw data. You got to have statistical data coming into the system. So they're not going to get you at the very top. In 2008, they got out at the end of January. Market was already down 6%. Sorry, that's how it works. This year, in our tactical stuff, got out of emerging markets June 1st. Since June 1st, emerging markets has done what? Boom! It's come down pretty hard. Probably not over yet either. That's what the systems are designed to do. They're to take basically anything that's mathematically, statistically viable and actually give us that data and be able to crunch all those numbers and do it in a non-emotional way. It doesn't care what's going on in the world today. The systems don't care. They only care about what data they're seeing. So what it's able to do is, by reducing, not eliminating, but reducing those hits in the bear market, what happens to your portfolio, and that exact same portfolio, is tremendous. It's the old adage, if you take a dollar bill and you lose half of it, you have 50 cents, right? So you lost 50% of your dollar bill. You get your dollar bill back to $1, that 50 cents, you're gonna have 100% return. It's the old adage, Peter Lynch used to say this all the time. Don't take the big hit, don't take the big loss. If you can avoid the big loss, you start out so much higher when the market turns around. So, the other thing that we do is monitor the performance. We use something called Asset Lock. And by the way, this is free. Asset Lock Personal, you can put this on any of your portfolios. And what Asset Lock does is it's simply this. It looks at your investment account. You give it a threshold, a number, a percentage that you don't want to lose any more than X on your entire account. We're not talking about individual. This is not like a virtual stop loss. This is a virtual stop loss for your portfolio. It's a little different. And on any account that you have, doesn't matter if it's a 401k, 403b, it could be anywhere. You can even put it on any of your accounts at Merrill Lynch. It doesn't matter. This is a way that you can monitor your accounts. It sends you information as far as, what's going on with the account, what's the high value, what's the high point of the account. It also tells you what if you have a 10% that you want to get out, that's the most that you're willing to lose in a bear market or in a major correction. It tells you what that number is, and it warns you when you hit it. So you're not guessing and saying, guess what, am I down 10%? Am I down 50%? I don't know. How many people keep track of their high water mark of their portfolio and how much they're down and where their max pain threshold is? Well, good for you. We got one guy here. So it's able to do that. And those are important, right? It's a way of keeping yourself involved with what your money's doing. So you don't just wake up one day and have a statement come in quarterly and, oh my gosh, what happened? It also keeps, and it lets you know exactly what's going on all the time, okay? It sends out information as far as what was your value of your account to your cell phone. There's an app. You can put this right on your cell phone. Keeps track of everything for you. By the way, it goes through all accounts, which is Morningstar, highly secured. Don't have to worry about it. This is a big, they have 16,000 companies that go through it, okay? So I think you can trust them. So this is just one of the things that they have. And they have the client dashboard that you can look at. It's really important. Again, it's what we consider important information that you can look at as a summary of what's going on with your accounts, right? It's an easy way to keep track of them. No longer do you have to figure out what the performance of everything is doing. And of course, that's the app right there. If you download it, you have to write that down.
Guys, if you take out your cell phones, you can download and get this app for free today. Text the 5AQ. I'll read the number. It's 947 222 5625, and you can get the app for free.
Anyhow, so I mean, with that said, I was going to end just with a quick story. Okay, so once there was a gentleman, and he was having an out-of-body experience, and all of a sudden he was sucked up to the pearly gates of heaven. And St. Peter walks out, and he's looking at us and says, "Well, you're 10 years to the day too soon. You're not supposed to be here. But to show you where you're not going to spend eternity, I want you to take the elevator over there and take it to the bottom." Well, the man gets in the elevator, a little trepidation, a little fear. And the elevator doors open up, and it's a devil. And he's having this big, big party, and everybody's laughing and dancing, and they're having hors d'oeuvres. They're having a fantastic time. Well, after a while, he goes back up, and St. Peter says, "Well, we'll see you in 10 years. 10 years of the day goes by, the gentleman comes back. And St. Peter looks down and says, "I don't understand. You changed your ways. You're doing all these things. You can't spend eternity behind the pearly gates of heaven. You got to go down the elevator." And the gentleman goes down the elevator. The elevator doors open up. And a fire, flame, and brimstone. And the devil grabs him. And he's about to skip him across the lava. The gentleman goes, "Time out. Last time I here is a big party." And the devil chuckles and he goes, "Last time you were here, you were a prospect. Now you're a client."
Thank you very much.
I'll be around out back.
Appreciate it. Thank you. So, guys, first of all, if anybody wants more information on the asset lock, we have the brochures at the booth, and also more information on the Solomon API at the booth as well, 307. So I'd like to just, before we just wrap this up, I just want to tell you, imagine for a moment, go back to 1999, go back to 2007. What if you had a tool like this? What if you were able to take the emotion out of everything, and instead of losing 6%, meaning you would give back 6% of your gains, instead of speaking to somebody going, "You know what, listen, it's not a real loss, it's a what? A paper loss, right? You felt good about that. And don't worry, the market comes back. Yeah, I know it comes back, but I'm 10 years older." So important. Do not have the big hits, big losses. Okay, I want to jump in the last part here on non-correlating assets. So important about that as we diversify moving forward. I'm going to bring up Josh Gilmore. He's going to touch a little bit about that, and then we're going to wrap this up. Josh, come on up, please. Thank you.
Perfect. Thank you, Richard. Hi, everyone. I'm Josh Gilmore. I have a decade of experience in alternatives and mainly non-correlating assets. You know, that's something that's been a huge sector of growth for us because a lot of clients who, if you go back to 2006 and you could put a portion into a non-correlating asset that isn't tied to the stock market, would you do it? Absolutely. So a lot of people are doing that now, and it's been a very popular part of our business. And I want to talk a little bit about how it's great to diversify and have a little bit of everything so you're not overexposed to one asset class. When you see an article like this, it doesn't scare me when Forbes says, we have no evidence of a strong organic economy, but an unhealthy artificial bubble that could lead to a next crisis. I'm protected, so are our clients, because we're diversified. It's not all tied to the market. And we follow the lead of a lot of high-level investors like Mark Cuban. Mark Cuban was interviewed less than a month ago saying that he's repositioning himself and he only holds a handful of stocks now. And that's just within the last few months. So can the market go up? I don't know. Of course it could. But it could also go down. So it's good to hedge your risk by doing some alternatives. There's one problem we've identified in this space, and that's, we raised your hand, a lot of you have IRAs and 401ks. How many of those are invested in stocks or something stock related, right? The vast majority, because the vast majority of investors have traditional IRAs like a Fidelity or a Charles Schwab, where that's your options. That's all you can pick. It's the suitability versus the fiduciary. So what we do is actually truly self-directed retirement accounts. Now, self-directed retirement accounts are really a missing piece of the puzzle. Less than 500,000 self-directed accounts are out there. And think about that in America, where we have over 300 million people. Less than 500,000 are self-directed. Who has a self-directed account? Could I ask who your custodian is?
TD Ameritrade.
TD Ameritrade? How about you, sir? Fidelity. Perfect. So, you guys can pick your own stocks, right? Your own options, your own funds. Unfortunately, those are not truly self-directed where you can actually own real assets. And that's the type of accounts we help our clients do. And it's important to understand that truly self-directed IRAs, in the eyes of the IRS, are exactly the same as a Fidelity IRA. The custodian you work with allows the broad or shorter options. And the bigger players out there only offer what they're used to and what they make a commission off of. So it's important to understand that and really broaden your horizons with one of these, even for just a portion of your portfolio. Our clients love the hedge and they love the security of having that type of account. And getting into it a little bit more, you know, it's really, the Fidelity is never going to tell you you don't have a truly self-directed account because they are making money when you buy from them. So only 4% of retirement accounts in the US are truly self-directed. So 96% of Americans do not have the ability to own an actual tangible asset with their retirement portfolio. And that's over $7.3 trillion there, and over $4.2 trillion in 401ks, which with your company, it's traditional. Now, someone we followed the lead of is a Mitt Romney. You know, a lot of people may remember in the last election cycle, it came out that he had well over $20 million in his Roth IRA. Think about a Roth IRA, you have contribution limits. So he didn't just put a bunch of money in there. He invested it correctly, and he did so using a self-directed plan. Investing in alternatives, he actually had an ownership position in it. So he didn't have the same volatility we're used to, and he was able to do things that have actually been around since 1974, but it's one of those pieces you're never gonna hear about it from your brick and mortar company because they make money investing the way that you always have, and your parents have, and your grandparents have. So this is a great tool that we use and our clients use to put ourselves in a great hedged position and be truly diversified. And I'll let Richard wrap it up.
Thank you. So I just want to, as I bring this all together, I want you to understand a couple of things. Number one, that I brought in, Matt with Solomon, and I have self-directed. My goal as a fiduciary-based advisor is to research. I don't work for these people. They work for me. They work for my clients. And what's working for them allows me to achieve these goals and objectives. And to wrap up, we talked about a lot of different things, right? We talked about the risks that nobody's talking about. They're maybe not sexy and exciting, but they're real. I want you to think about after this class, go home and think about family and friends. People will have serious health concerns, right? You may be doing it all on your own now, but who knows what's going to be later on down the road. Taxes are a big issue. So I try to bring all these things together because I hate to break this to you, but there is no one magic, hey, do this and it's all going to be perfect. I hate to break that to you, right? But I want to share with you a very short story before I wrap up. I want you to imagine for a moment you and your spouse or significant other, you go to a car dealership and you say, look, you know what? We're looking for a big car, big wheels, a lot of trunk space, something that's safe. So they said, okay, hold on, really great. They come back and they show you a shiny small sports car. You look at your spouse and you're like, no, let me explain. We're looking for a big car, safe, big wheels. I'm sorry, can you give me another chance? Sure, no problem. And after 10 minutes they come back and they bring you to another shiny small sports car. So you look at your spouse and you're like, let's get out of here. You walk out, and as you're walking out, you turn around and you look on the wall and it says Porsche. What were they going to sell you? What were they going to sell you, right? So I'm trying to bring home to you, I've hopefully shared with you some really, really important tools that the reason why people are, the portfolios that I look at every single week, the investments that people are making, the emotion that they're putting in there is a reason behind it. And there's nothing wrong with people making money, but it has to be in your best interest not somebody else's. So as we wrap up, look, I got to tell you, I'm not right for everybody, right? It's my firm. So I'll tell you who I'm not right for. If you're in here and say, look, you know, I'm willing to take really substantial risks with all the money, like, hey, I'm loving Bitcoin. I'm willing to take a 60% loss, probably not a good fit. You know what? A 30, 40, 50% stock market loss, wouldn't bother me. Probably not a good fit. You know what? If I took my money, put it into a 2.5% CD, paid some taxes on that, I'm good, I can live on that. Probably not a good fit. But if any of these things are concerned to you, protecting from a catastrophic illness, tax planning, you know, true diversification, things like, if that is truly something that concerns you, then maybe you could possibly have a conversation further. And my goal here, ladies and gentlemen, is as follows. You come by the booth, I have you a copy of my book. I did that as well. We have a couple of other things to give away. And I want to really answer any questions that you guys have, certainly here on a macro level. You come by the booth a little bit. I'm here to talk to you a little bit more. And I appreciate you taking the time out, and I hope you took some things away with you here today that can really have a significant impact. So if there are any high-level questions, if not, we'll meet you guys at the booth. Anything in particular?